The system is against you. In this, the institutions are being held back by regulation and can't do it. But we're not. And we know that they have a lot of money because it's actually our pensions. They're going to put our pensions in this in the end. Well, we might as well make money from them coming into the market later and driving up prices ridiculously, because that is what's going to happen. The network that Ethereum and Bitcoin does, you're the owner of the network and the user. So as a user with the NFT, you're actually owning a share of the network itself. So everybody uses it, owns a part of it. Therefore, if the network's going to get used a lot, you're all going to get rich.
Raoul is a former hedge fund manager and Bitcoin enthusiast. He explains why he sees us in a deep recession, what the smartest people are buying, and why it is time to get back into crypto. So make sure to watch till the end to find out how you can build wealth in this recession.
I think there's three things you need to do here. Income. Income pays your bills. Income can pay your mortgage. Income does everything. Without income, you got nothing. Optionality. You need to have things that can pay off. A startup or a hobby business on the side. That will never happen if you work for a corporation. Focus on your income. Work hard. Look for other opportunities that can leverage that. And then thirdly, if I've got this income, look for investment opportunities that can change my life. That's why being an entrepreneur is so damned hard. The narrative of entrepreneurship is start thing in garage, borrow money off parents, or start it on your credit card. 3 years later, billionaire. Right? That's the narrative. And then you write your book on how I manage my company. That's actually not true. The best book ever written on this is Ben Horowitz's The Hard Thing About Hard Things. What you have to do is battle both your assumption, as you say, and test it endlessly. You have to be paranoid, excessively paranoid, but still confident in that you're right. And you also have to accept the risk of failure, because the moment you accept the risk of failure, which is very high in startups, you'll start hedging against it. Once you stop worrying about failure as the narrative, you tend to attract it. It's a really difficult thing. People who fear failure above all things tend to fail more. People who don't look at failure and just look at the moonshot tend to fail too. It's the people who can see failure as a wolf behind them and the testing of their ideas, but still having conviction and maybe changing paths because the wolf is catching up, they tend to fail less. But it's hard, it makes you feel sick, you don't sleep at night. It's called The Struggle. And The Struggle is probably the most profound 2 pages in all of entrepreneurship. And it's true, and it's hard. It's because when you're able to borrow, because you're the richest dude in the street who earns the most money, which is the United States, and humans have a propensity to borrow to create the image of this future self. The future self was the amazing United States of America, that dream that we had in the 50s. That dream died decades ago. And to fund that dream, the mismatch between the dream and the reality is debt. Sometimes debt is not all bad, right? Sometimes it can help accelerate some of the things. But if you're doing it to fund a dream that's never going to exist, that's the danger. Another thing that is patently obvious is technology is not going away. Now, it's not easy to pick the right technology stocks, much like it's difficult to pick the right NFTs or tokens unless you really know what you're doing or you know that particular company or that project. But if the thesis is that technology is going to continue to have this ridiculous adoption, whether it's AI, EV, whether it's robotics, whether it's genetic sciences, all of these things that are around us, space travel, well then if it's being sold in a fire sale because everybody's panicking, well, surely that makes sense because technology has outperformed the market for the last 40 years. So you always want to be buying technology. So you're in your 30s, you look at your 401k and you've still got your income, because that's the most important thing of everything. You've got your income, you should be going, okay, I should be buying technology stocks and I should be buying crypto because these are long-term megatrends. The mythology is investing is hedge fund manager George Soros spots the opportunity, gets in at the right price, makes a fortune. The reality is most people have no idea where the price is going over a short term. So what happens is you buy something, you put all your money in, you've saved up your $5,000, you put it all into Bitcoin, Bitcoin falls 50%, you panic, you sell it, you feel terrible, Bitcoin goes back up again, you feel even worse now, you can scrape together, you've lost half of your money now, and then you keep compounding these errors. So what is dollar cost averaging? Dollar cost averaging is basically what everybody does with their 401k. The problem is with 401ks or retirement funds is nobody cares about them. You don't know what's in it. You have no ownership. You just put some of your salary away and it goes in this mythical thing that you probably assume won't be worth as much money as you hope it is. That's what that's become. And you put it in every month. Why do you do that? Well, because you're averaging all of the highs and lows over time, because markets tend to do this. So you're kind of indifferent. In fact, you love it when it falls because you're buying more units at a lower price, because your game is to own as much as you can at the lowest possible price. But if you don't know how to market time, and 99.9% of people don't and can't and shouldn't, then you just average in over time and magic will happen. You just average a beautiful price over time. And had you done that in the S&P or anything else, you make money. Now, what's so lovely about Bitcoin is it's not a passive investment like your retirement fund, because a retirement fund you can't access until later. So you kind of write it off. Everybody's heard that it's never going to be worth as much as it should be anyway. So it's become a bit of a pain as opposed to something that this you own. You live and breathe that volatility and you live and breathe those gains when they happen. And you will be like wide-eyed. So what they're saying is the future opportunity is going to be big and it's going to be cheaper than it is today. Now, will they time it properly, etc.? Doesn't really matter, but here's what the smartest people are saying is the future opportunity is better than the present opportunity. We don't know when they had that bet. They might have done that 4 months ago, in which case it's been a very good bet and they'll be looking to deploy. And if I read their investor letter, they say they're now starting to look to deploy stuff into interesting opportunities where things are really cheap, which is the thing I said before. When the market throws out the baby with the bathwater, that's when you start finding the things you really like. In crypto world, things like Solana, great project, down 85%. There's a whole bunch of these big layer ones with network adoption effects already. These are not super speculative assets. They're obviously speculative, risky, but not super risky. They're all down 80, 85, 87%. Okay, that becomes interesting. The world has a history of money, whether it's backed by gold or not, where government gets themselves excessively into debt and they devalue the money. So the Romans used to clip the edge off the coins so there was less gold in each coin. And eventually people would lose faith in the coins because they blend them with silver and then blend them with copper. And, the coins were worthless because that was supposed to be worth the value of the denarii in Roman times. But governments can't help themselves. Humans, we're just humans, right? Humans are fundamentally flawed creatures and we always will be. If you're really thirsty and I gave you a bottle of water or sold it to you, you'd probably pay me 10 times too much for that bottle of water. If I give you 1 million bottles of water, they're worth precisely 0 to you. So scarcity has value. That's art, that's cars, that's almost anything. Humans value scarcity for whatever reason we do. And so if you're printing too much money, you're creating less scarcity. So yes, there's money everywhere, but the money has less value. So once you understand that, what does it mean? The dollar hasn't collapsed. It's kind of where it was versus the euro in the last 5 years or whatever it is. And then you say, but my $50,000 salary now can buy me much less shares in Apple, Amazon, Google, Microsoft. In fact, units of the S&P 500. I suddenly can't buy as much. Since 2008, it's a fraction. I can buy like a third of what I could. Same with real estate. Same with gold. And then you're like, assets have suddenly got expensive. They haven't. The value of your savings has gone down, or your money. So Bitcoin comes along in 2008, in the middle of the crisis. It's kind of like it was perfectly prepared for this. Satoshi goes, hey, look at this. I can create an algorithm that only creates so much of this thing, the Bitcoin, and it can never vary, ever. So therefore, this is scarcity. Any of these big IPOs that have just happened, what they're basically doing is there's a bunch of VCs who've made 1000x, 100x, whatever the number is, and have got obscenely rich, investing in something that you're not allowed to invest in because of the law, because you're not an accredited investor. And in fact, the system's so set up that you're never, ever going to be shown this opportunity. And then at the very end, when the asset's gone up so much, they then list it on the New York Stock Exchange or the NASDAQ. Your probability of success is always lower than those guys. So the system is against you. In this, the institutions are being held back by regulation and can't do it, but we're not. And we know that they have a lot of money because it's actually our pensions. And so they're going to put our pensions in this in the end. Well, we might as well make money from them coming into the market later and driving up prices ridiculously, because that is what's going to happen. Once this ETF is listed, every RIA in America is going to be advising their clients to buy the Bitcoin ETF and the Ethereum ETF, and it'll drive another $500 billion of price appreciation. This is all coming, and it is the opportunity in the future platform of the Internet of Value, and you're paying nobody any fees.
We hope you enjoyed this video. Do you think it's the right time to get into crypto? Let us know what you think in the comments below.